In one single day, SpaceX became one of the 10 most valuable companies on planet Earth. Bigger than Tesla, bigger than ExxonMobil, bigger than almost any industrial company in history. And here's the part that breaks everyone's idea of what this company actually is. 61% of SpaceX's revenue doesn't come from rockets. It comes from Starlink, the satellite internet business. The rockets you've watched launching for the last 20 years, the ones plastered all over every headline about this IPO, aren't even the main event anymore. The most hyped IPO of the decade might also be one of the most misunderstood. So if the entire internet suddenly wants a piece of SpaceX stock, the real question is, what are people actually buying? And more importantly, is it already too late to get in? Let's rewind to what actually happened. On June 12, 2026, SpaceX priced its IPO at $135 a share, raised $75 billion in a single offering, the biggest IPO ever recorded, and started trading on the NASDAQ under the ticker SPCX. By the time the closing bell rang on day one, the stock had jumped 19% to $161, pushing the company's valuation past $2 trillion. 21 banks worked on this deal, and in the months leading up to it, SpaceX quietly merged with xAI, Elon Musk's artificial intelligence company. So the stock everyone's scrambling to buy isn't just a rocket company anymore. It's a satellite internet provider, a rocket manufacturer, and an AI company, all stitched into one ticker. Now here's where it gets interesting. Because once you actually open up the financials SpaceX filed with the Securities and Exchange Commission, the story flips upside down. In 2025, SpaceX generated about $18.6 billion in total revenue. Starlink alone brought in $11.4 billion of that, 61% of the company, growing 50% year over year. And Starlink isn't just big, it's the only part of SpaceX that's actually profitable, generating $4.4 billion in operating profit, up 120% from the year before. By February 2026, Starlink had crossed 10 million active customers in 160 countries. Let that sink in for a second. The internet service beamed down from satellites is quietly outperforming the rockets that made this company famous. And this is where the story gets weird, because the part of SpaceX everyone talks about isn't actually the part making the money. So what about the rockets? Falcon 9, Falcon Heavy, Starship. The whole launch division generated about $4.1 billion in revenue in 2025. But that segment actually lost $657 million. The part of SpaceX that gets all the attention, the part with the iconic landings and the Mars dreams, is currently losing money. And then there's the new piece, the AI business from the xAI merger. That segment brought in $3.2 billion in revenue, but it lost $6.4 billion in a single year. $6.4 billion. That's not a typo, and that's not a small number even for a company this size. And here's where it gets even messier. Add it all together, and SpaceX posted a net loss of about $4.9 billion in 2025, while spending roughly $15 billion on capital expenditures. So here's the uncomfortable truth sitting at the center of this stock. A company just went public at a $2 trillion valuation, one of the largest in the world, and it lost almost $5 billion last year. The part everyone's excited about, rockets, Mars, AI, is the part bleeding the most cash. And the part quietly paying for all of it is internet service beamed down from orbit. So is it too late? Here's how to actually think about that, instead of just guessing based on the first day headline. A 19% pop on day one feels huge, but first day moves are almost meaningless for long-term investors. What actually matters is what happens over the next 6 to 12 months, because that's when early employees and venture investors typically come out of their lockup periods, usually somewhere between 90 and 180 days after the IPO. When those lockups expire, a wave of selling often hits the stock, sometimes dragging the price down significantly, regardless of how the business is actually performing. Sometimes, that selling pressure creates better entry points, but only if the business keeps proving the valuation. There's also the valuation question. At a $2 trillion market cap on $18.6 billion of revenue, the market is pricing in years of explosive growth across all three businesses, not just Starlink. If Starship delays drag on, if Starlink's growth slows as it saturates easier markets, or if the AI spending doesn't translate into revenue fast enough, that valuation has a lot of room to compress, even if the company itself is doing fine in absolute terms. None of that means the stock is a bad investment. It just means the easy money, if there ever was any, was made by the people who bought in before the IPO, not on day one. So let's say you've decided you do want exposure to this, but you're not interested in dumping your entire savings into one ticker the week it goes public. Here's a framework worth thinking about. And I want to be clear. This is an educational starting point, not personalized financial advice. Picture $100,000. Instead of putting it all into SPCX on day one, you might build a core position with around 40% of that, buying in gradually over several weeks or months rather than all at once, so you're not catching the stock at its most emotional, most overpriced moment. Another 20% could go toward the broader space economy, companies that fly payloads on SpaceX rockets, satellite component makers, ground infrastructure providers, names that are already public and have actual trading histories, giving you exposure to the same trend without betting everything on one company's execution. A third chunk, another 20%, could sit in the boring legacy aerospace and defense names everyone's ignoring right now, companies with decades of government contracts and steady cash flow that act as ballast when the high-growth names get volatile. And the remaining 20%, the part most people skip, just sits in cash or a broad index fund, ready to deploy when those lockup periods expire and the inevitable dip shows up. Before you go anywhere near this stock, here are the 4 things worth repeating to yourself. SpaceX is now worth more than almost any industrial company on Earth, and most of that value comes from internet service, not rockets. The rocket division, the part everyone associates with SpaceX, is currently losing money. The brand new AI business lost $6.4 billion in a single year. And despite a $2 trillion valuation, the company as a whole lost almost $5 billion in 2025. If any one of those facts surprised you, you weren't alone. And that's exactly why so many people are about to buy this stock without actually understanding what they're buying. If this changed how you're thinking about the SpaceX IPO, hit subscribe, because we're going to be tracking SPCX closely over the next few months, especially around that lockup expiration window, which is historically when the real opportunities show up. And drop a comment after hearing the actual numbers. Do you think SpaceX is worth the price tag? Or is this the most overhyped IPO of the decade? I read every comment, and I'll see you in the next one.